Good day, and welcome to the D-Marq-AnalyticS channel. The time has finally come. As in today's video, we will walk you through our winning investment strategy, the exact approach we use to build a portfolio that delivers both steady income and strong capital growth. This is just a suggestion for you all to consider and research, and certainly not financial advice. Let's get started. You must understand that this isn't about chasing hype or timing the market. It's about building a resilient, diversified portfolio that can withstand recessions, adapt to changing markets, and keep compounding wealth year after year. We'll show you some selected actual stocks we've chosen, why they're resilient, and how we use a tiered allocation system to keep our portfolio balanced and our IRR consistently high. If you've ever wondered how to combine income and growth into one powerful strategy, and you're serious about reaching financial independence through smart investing, stick around. This is for you. Section 1. The core philosophy. Our strategy is built on 3 pillars. 1. Diversification across sectors and countries. We don't put all our eggs in one basket. Our portfolio spans industries like technology. Examples can be NVDA, TSM, MU, ASML. Healthcare. Examples like J&J, MCK. Consumer staples. Examples like KO, PEP. Energy. Examples like CVX, TPL. And financials. Examples like V, MA. Plus exposure to different regions. Example, when also adding a global ETF to the stocks, it adds exposure to the biggest names of every region that may include names that we like and previously held individually. The likes of Taiwan Semiconductor, Alibaba, ASML, Samsung, Xiaomi, SAP, SK Hynix, Schneider Electric, Hitachi, Mitsubishi, to name a few. This reduces risk and captures global growth. 2. Resilience through recessions. Most of our holdings have proven track records of surviving and even thriving during downturns. These are companies with strong balance sheets, reliable cash flows, and products people need no matter the economy. In addition to the example tickers mentioned in the previous section, other stocks such as BR, FIX, ACN, RGLD, CAT, ADP have all increased their dividends during the previous recession. 3. Dual focus, income plus growth. If you want your portfolio to pay you today and grow tomorrow, that means combining dividend-paying stocks for steady cash flow with high IRR growth names that compound capital over time. Examples of the dividend-paying stocks are the tickers mentioned in the previous section. As for the high IRR growth names in our portfolio, they include tickers such as AGX, ANET, STRL, to name a few. Section 2. Why these stocks? Let's talk about why we've selected the specific stocks in our portfolio. Dividend anchors. These are companies with decades of consistent dividend payments, often increasing payouts year after year. They form the backbone of our income strategy. Think of consumer staples, utilities, and certain financials that keep paying even in recessions. Growth drivers. Here we focus on companies with high return on invested capital, ROIC, and strong internal rates of return, IRR. These are often in tech, healthcare, or emerging markets. Businesses reinvesting profits at high rates to fuel future growth. Defensive plays. These are stocks that historically hold up well in downturns, like healthcare providers or consumer goods companies. They protect the portfolio when markets get rough. Global diversifiers. We also include international exposure to reduce reliance on any single economy. This helps capture opportunities in regions that may be growing faster than the US or Europe. Section 3. How it all works together. What makes this strategy powerful is how these pieces fit together. Our tiered allocation system ensures capital flows dynamically, more into high IRR opportunities when they're attractive, and more into dividend anchors when we want to lock in income. An example of a tier strategy can be as follows. Tier 1 can be your core dividend anchors, as they provide stability and income. Tier 2 can be your growth drivers that will get significant but slightly smaller allocation, as they are deemed high growth stocks that may be also volatile. Tier 3 can be your defensive utilities, with a smaller allocation, but provide protection during downturns. And Tier 4 can be your global diversifiers, with a modest allocation to reduce US-based companies' bias. To maintain a high IRR, you can add fresh capital every month on top of reinvesting dividends, compounding growth faster, distributing the amount into the different tiers based on your portfolio's current IRR. As it goes low, invest more in the higher IRR stocks, otherwise distribute equally to also get more dividends. For example, if a Tier 2 growth stock is trading at attractive valuations and shows projected IRR above 30%, allocate more capital there. But if valuations are stretched, then rotate into Tier 1 dividend anchors to lock in yield and stability. This dynamic rebalancing can help you maintain your portfolio's IRR above 30% while still compounding income. Guardrails on sector and country exposure keep the portfolio balanced, so no single risk dominates. This way, you're not just picking good stocks. You're building a system that adapts to market conditions, while keeping yourself on track toward your goals. Section 4. The results and the goal. In our tier distribution system for our portfolio, we have also added buy and sell trigger columns to have us value invest at the finest level. Remember to also keep yourself well informed on a daily basis on all news, numbers, and reports on each stock you own. Our buy signal triggers when the stock is at a price lower than our initial investment and either trading at a discount or fair value. On the other hand, the sell signal is triggered when the price is higher than our initial investment and is trading at very high premium way beyond its fair value. We lock in some profit that is reinvested elsewhere. An example short-term goal can be that you would want to reach $12,000 in annual dividend income, while maintaining a portfolio IRR of at least 30%. Every month, track progress, reinvest dividends, and refine allocations. Remember that reinvesting your dividends accelerates compounding. Monthly contributions, plus the tier system, can ensure that you always buy the best opportunities. And gird-railing sectors and countries' exposure can prevent overconcentration. The long-term vision is a sustainable, diversified portfolio that supports financial independence, income you can rely on, and capital that keeps growing for decades. When choosing to invest in individual stocks and certain sectors, it is extremely crucial that you understand why you have chosen a certain stock, or why you're investing more in one sector than the next. Let us explain with a real example from our portfolio. If you've watched our previous videos, you would notice our bullish sentiment in the AI boom. Having said this, we have carefully chosen stocks that play a crucial role in the field that we believe will only grow, since the AI spending is real, as the Mag 7 committed billions of dollars to build data centers globally. With this in mind, let us explain the details. Our information technology holdings, NVDA, MU, TSM, ASML, CDNS, ANET, CSCO, ACN, CRDO, and VRT form the digital backbone of the AI economy. From NVDA's GPUs and MU's memory, to TSM's foundry capacity, and ASML's EUV lithography, we've captured the most critical bottlenecks in advanced computing. CDNS provides the design software that makes next-generation chips possible, while ANET, CSCO, and CRDO ensure that data can actually move at the speeds AI requires. ACN bridges the enterprise adoption gap, helping corporations integrate AI into workflows. And VRT supplies the physical infrastructure, power, cooling, racks, that keeps hyperscale data centers running. Together, these names give us exposure to every layer of the AI stack, from silicon to systems integration. But AI doesn't live in a vacuum. It requires massive physical expansion. That's where our industrials cluster, STRL, MTZ, FIX, CAT, AGX, GEV, comes in. These companies are the builders and enablers of the infrastructure wave. STRL, MTZ, and FIX specialize in engineering, construction, and mechanical systems for data centers and energy facilities. CAT provides the heavy machinery to make those projects possible at scale. AGX and GE Vernova, GEV, bring power generation and grid expertise, ensuring that the surging electricity demand from AI can actually be met. These holdings don't overlap with our IT names. They complement them by ensuring the physical world can keep pace with the digital one. Then we've layered in Equinix, EQIXIX, in real estate, and Constellation Energy, CEG, in utilities, which tie the ecosystem together. EQIX monetizes the data center boom directly, offering co-location and interconnection services that hyperscalers and enterprises can't do without. It's the recurring revenue counterpart to the cyclical construction plays in industrials. CEG, meanwhile, provides the clean, reliable power that AI workloads demand. With its nuclear-heavy generation mix, it's positioned as a strategic enabler of the AI economy. Without abundant, carbon-free electricity, the AI build-out simply can't scale. This isn't just diversification, it's complementarity. Each holding reinforces the others, giving us exposure not only to the explosive growth of AI chips, but also to the broader, less crowded opportunities in construction, infrastructure, energy, and recurring data center revenues. It's a portfolio designed to capture the AI boom from every angle, while balancing cyclical upside with secular, defensive growth. In this same way, look at your current portfolio and do the same with fields and sectors you may be bullish on and believe will grow in the future, or are long-term strongholds. Section 5. Closing. So that's our winning investment strategy. A diversified mix of dividend anchors, growth drivers, defensive plays, and global diversifiers, all managed through a tiered allocation system that keeps our IRR high and our income growing. If you found this helpful, hit that like button, share with your friends and colleagues, subscribe for more deep dives, and drop a comment with your own investing approach. We'd love to hear how you're building your portfolio. Remember, investing isn't about luck. It's about discipline, strategy, and patience. Build smart, stay consistent, and let compounding do the heavy lifting. We would like to thank you all for staying till the end, and we wish you all have a successful investment journey.